Credit score. That's what lenders look at when they're qualifying you for a house, right? Not so fast. Today, we are going to discuss the debt-to-income ratio and why that is so important when you are starting to look for a house. Now, basically what a debt-to-income ratio is a way to figure out how much house you can afford. Why is that important? Because the bank wants to know that you can afford the loan that they are about to give you. So what is the easy definition? Well, the easiest definition is your money going out versus your money coming in. And at the end of the month, when you're done paying all your bills, how much of that money is left for a house payment? So the bank doesn't look at everything that you have to pay out. They don't look at living expenses. They look at debt. So they're going to look at things like your auto loan payment, your credit card payment, could be child support, anything that has a minimum balance every month. Now remember, they don't look at the balance. They just look at what you have to pay on a monthly basis. But on the flip side, when the bank looks at your income, they're not only going to look at the gross pay of your job, but they're going to look at other things too, like alimony or child support that you may be receiving, any disability payments, any pension, or if you have a rental property, 75% of that income can also go as income for you. Then they take the total of your monthly debt that you are paying out and divide it by your monthly income coming in. And that ratio that they get is your debt to income ratio. And the lower that number is, the better. And for any self-employed people out there, your lender will do an income analysis for you, and they will look at your business income versus any or all of the write-offs that you have, and they will help you come up with your income number. So let's say that you have found a house and you go into your lender and you want to buy that house. Your lender is going to look at all of those payments that you have going out on a monthly basis. They're going to add that house payment to go with it. Then they're going to divide by the amount of money that you have coming in, and they are going to come up with that ratio. And then the banks use that ratio number to decide whether or not you can afford the payment for the house that you want to buy. And there are actually two different ratio numbers. One is called the Front End Dti, and one is called the Back End Dti. The Front End Dti is looking at just the house payment itself versus your income. That will come up with one ratio, a lower ratio. Then there's the Back End Dti. That's where the bank looks at what that house payment would be for the house that you want. They add in all of those monthly payments that you have to make, that debt, then divide it by your income. That comes up with a higher ratio called the Back End Dti. Now, the bank will look at both of those, but more important is the Back End Dti, because that's a more complete picture of what your monthly expenses are and a more complete picture of the affordability of that house. And it's important to know that different loans have different DTIs. They usually come in a range. Most loans are going to stick to the bottom part of the range. But if you have things like lots of money in the bank, or there's a list of other extenuating circumstances that you may be able to meet, you could go to the higher part of the range. But for the most part, it's going to be the lower part of the range. So a conventional loan right now is a range of 36% to 50%. FHA is 43% all the way up to 56.9%. VA is 41 to 50% right now, and USDA is 41 to 44%. And all of those loans pretty much all have a front-end DTI of about 31%. And just know when you're talking about the house payment is actually a bunch of things all grouped together. It is the principal. It is the interest that you pay every month. It is the taxes that you'll need to pay every month. It is the homeowner's insurance that you have to pay. If you buy a townhouse or a condo or any single family home that is in an association where you pay monthly dues, those HOA, those monthly dues are included. And if you put down less than 20% and you have mortgage insurance, that mortgage insurance payment is in there as well. So all of those payments are all lumped together in your house payment. So let's just say you've already gone out and you have found a great house and you went into the mortgage calculator online and you figured out a rough idea of what that monthly payment is going to be for that house. Okay, so let's just say that is going to be $1,500 a month. Well, and you also have a $200 a month car payment, and you have credit card payments that altogether add up to $300 a month. So you are putting out in debt a total of $2,000. But you are bringing in, your income coming in is $5,000. When you take your $2,000 in debt that you have, divide it by the $5,000 in income that you have, and you get a debt to income ratio of 40%. Now, that may not work for a conventional loan, but it'll certainly work for an FHA loan whose DTI requirement is 43%. And if you did have your heart set on a conventional loan, well, the first thing that you need to do is go to your lender, because you need to make sure that that number is as accurate as it is. Maybe they might, if you have a great credit score or something like that, they might be able to stretch that up higher for you. But at least now you know. Now, the other place that this comes in handy is, let's just say you're at the beginning of your home search and you want to know, how big of a payment will I qualify for? How much can I afford? And let's just say that you've done your homework and you've decided that you're pretty sure you're going to go with an FHA loan. So you are aiming for a DTI of 43% or lower. So take that $5,000 of income that you have, and then you want to multiply by the 43% of DTI that you are, that's your maximum threshold. So 5,000 times 0.43 is 2,150. Then we're going to subtract those monthly debts that we have, that car payment and those credit card payments. For us, and in this example, that's the $500. So the $2,150 that we have minus the $500 in debt, that gives us a maximum monthly housing payment of $1,650. So now you know that when you're out looking for houses, that is the maximum number that you are going to qualify for under an FHA loan with the current debt that you have. And just know that I would be deeply indebted to you if you would go down below and like this video. Now, if you're running the numbers for yourself and you're seeing that your DTI is just a little too high, or you just want to get it a little lower, are there ways to do that? Absolutely. Now, obviously, the big elephant in the room is buy a cheaper house. But if you have your heart set on a certain area or a certain house or whatever, there are ways to get that DTI a little bit lower. The first thing that you should do is pay off any debt that you can pay off. If you've got a credit card that's got a couple $100 on it, pay that off so that you get rid of that monthly minimum payment. Get that off your books. Another thing you can do is, if you have an auto loan and some credit cards, you could go and get a personal loan and consolidate those debts. So instead of a $100 payment, $100 payment, and a $100 payment, put all those together and get one $150 payment. You can also shop for houses in a lower tax area, because those taxes are factored in on a monthly basis. If you go live in a city that's got a lower property tax rate, that will lower your DTI as well. And if you are looking for a townhouse or a condo, certain associations are more expensive than others. So go to find an association that has lower association dues. And you can also add a co-borrower or a co-signer to the loan that has a better DTI than you do. And just a reminder that as you're out there looking for houses and trying to figure out your whole affordability picture, remember to look at the whole picture. The bank can say that you qualify for $2,000 a month, but they don't look at your other monthly expenses, your cell phone bill, your food bill, whatever it may be. So when you're looking at your affordability picture, make sure that you factor in everything to make sure that that payment is comfortable for you. And by all means, go talk to a lender. Even if you're not ready to buy yet, go talk to a lender. They can help you get a very, very clear picture of what is affordable, what you can qualify for, what you can afford. They can help you look at the whole picture and help identify ways that you can improve your DTI number. Click right here to learn more about the differences between conventional loans and FHA loans. If you're ready to move on to the next step of figuring out which loan you want, now that you are a DTI expert. Thanks for watching. See you next time.